welcome to Strategy Saturday. I'm Charles Carillo. Today we're breaking down how to stress test a multifamily deal so you can see how much could go wrong before the property starts losing money, because stress testing isn't about being negative, it's about protecting your downside. Let's get started. When we are stress testing a deal, we adjust the underwriting to see how much could go wrong before the deal starts losing money. This is mainly focused on adjusting for vacancies, expenses, and interest rates. Number one is past income and current expenses. So this is my favorite stress test. And step one is to normalize all property expenses to what you believe they will be after purchase. This includes the property taxes that will be adjusted, your insurance quote, and your maintenance expenses. Step two is to take the seller's average monthly gross income over the past 12 months and see if the property will still cash flow with the new expenses. If it still cash flows, then it has passed the stress test. Furthermore, if you are planning to renovate the property and raise rents, this provides an additional buffer as you begin implementing your business plan. Number two is the break-even occupancy test. We want to take those normalized expenses, the actual ones you'll be paying after purchasing a property, add your mortgage to that number, and divide it by the property's gross potential rent upon purchase. Now, this is the rent you would collect if 100% of the units were occupied and everybody paid. So if the property has 10 units that rent for $1,000 per unit, the property would have a gross potential rent of $120,000. If the property has $80,000 in annual expenses and mortgage costs, your break-even occupancy would be 67%, which is great. That means you need your property to be only 67% occupied with paying tenants to cover your bills. You are looking for property with a break-even of no more than 80%. Our goal is the high to mid 70s, and the lower, the greater the margin of safety. Number three, expense and income growth. This is easy to calculate. Remove all rent increases for the first 24 to 36 months while your expenses increase. If you have already normalized the expenses, test it with a 5% annual increase and see how high you can go before the deal stops cash flowing. Number four, interest rates. If you have 5-year term debt or less, you need to be aware of interest rate sensitivity. The longer your mortgage interest rate is fixed, the less important this analysis becomes. If you have a 20 or 25-year term, by the time that debt comes due, you will have little to no mortgage on the property. Even after 10 years, your value will have greatly increased in most scenarios. Adjust your underwriting to see how high your interest rate can go before the deal stops cash flowing. Additionally, at what interest rate does your DSCR, debt service coverage ratio, drop below 1.25, at which point you would start having issues obtaining financing. Number five, exit cap rate expansion. The profitability of a deal can be significantly altered by adjusting the exit cap rate. I always adjust this when someone sends me underwriting, usually to invest in one of their deals. Change it by just 0.1% to 0.5% and see how much it changes returns. It can be quite significant in most deals. Stress testing a deal involves taking your underwriting and adjusting it negatively until the deal doesn't work. The further you can manipulate your income downward and your expenses upward, the more you will see how good your deal actually is and if it's truly resilient. If you're interested in learning how property expenses increase as properties get older, check out episode SS252. That's SS252. I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.